Welcome to the Wealth Podcast. This is episode 513. Today is March 24th, 2026. I'm your host, John Pugliano. I'm also the founder and money manager at investablewealth.com. Wait, today I got a quick episode for you. I know the world is in panic. The narrative continues to be that we're on the verge of World War III. If you're a long-term listener to the podcast, you know I view these episodes as buying opportunities. This one is no different. That's just my opinion. It doesn't mean things won't fall apart and drop 20% tomorrow. But the way I look at it is from the long-term strength and resilience over the U.S. economy. I tried to make that point in the previous episode where I talked about how bad things were in 1968 and think of all the things that have happened since then, and yet the economy continues to grow and prosper, as does the stock market. So bottom line, I just want to cover in this episode what you're not hearing in the headlines, and that's that things like the Mag7 are on sale right now. And I don't think they're on sale because they're bad opportunities. In fact, these are positions that are in my portfolio. They've been there for quite a while. I am not necessarily loading up and buying more at this point, but I do think they're at excellent buy points. I have no intentions of selling them, and I think in the next 3 to 5 years, people will look back as this being another fantastic opportunity specifically to get into the Mag7. Now, the interesting thing about this, too, that I want to point out is that I'm not a fanboy of the Mag7. In fact, 3 or so years ago when everybody loved it, I was very skeptical. Now that everybody hates them, well, again, I'm a contrarian. I like them. I'll tell you why in a minute. Before I get to that, let's look at the panic trade. I hear from people saying, should I be buying gold? Should I be buying oil? Well, let me tell you, the time to buy ExxonMobil was like 5 years ago. You wanted to be buying ExxonMobil back when the narrative was that the world was moving away from petroleum and everybody was going to go to EVs, and lithium was the thing you wanted to invest in. I have ExxonMobil in my portfolio. It's been there since, I don't know, either just before or into the pandemic. I forget when I bought it the last time. But it's been a great dividend payer. It's very, long-term, has good growth and stability. And in panics like this is specifically when you want to own it. Now, listen to what I said. I didn't say you want to run out and buy it, but this is when you already want to be owning it. So the time to buy it, like planting a tree, it was years ago. It's not today when everybody's panicked and talking about it. So yes, it's in my portfolio. No, I don't have any intentions to sell it, but I'm also not running out and buying it. And briefly, let's talk about oil in general. People are losing their minds right now, and I don't deny the fact that this is probably the most consequential military action that's happened in the Middle East in the last 40 years. But the fact that it's happening now and that it didn't happen 10 or 20 or 30 or 40 years ago, again, attests to the strength and stability of the U.S. economy. The reason we didn't take these type military actions 30 years ago against Iran is that our economy couldn't have sustained it. We needed foreign oil reserves much more drastically back then than we do now. There are a lot of other people that do need the oil, and again, I think that's why we attacked. I think it's part of the plan. I'm not going to go down that rabbit hole today. Bottom line, what I want to point out is bring up a long-term chart of oil. Right now, even with the major panic and the shutdown in the Straits of Hormuz and the concern about escalation, U.S. West Texas Intermediate is right around $90 a barrel. Look at a long-term chart. Look at what West Texas Intermediate has traded at over the last 15 or 20 years. You factor in inflation and you factor in the war panic that we're in right now, and this price is actually unbelievably low. I'll also point out that the people that right now, and I'm talking about the analysts, the energy analysts and the talking heads all over media, the people that are telling you that oil is going to $250 a barrel, listen, I got no idea whether it will or won't. But I do know this, those exact same analysts, if you go back about 8 or 9 weeks ago, they were telling you that there's a global oil glut and that oil was going down to, the $40 barrel range. So it's all minutia and nonsense. These people don't know any more than you do. Something else I want to point out about this panic trade, the people that want to rush into gold, or the obsession that the US dollar is losing value and is not going to be the world's reserve currency. Listen, I'm not going to argue the point, but go look at the scoreboard. US dollar sitting right now in terms of the Dixie index right around 99. And again, zoom out. Just don't look over the last year, the last 15 months. Zoom out over the last, since 1987. What is that? Close to 40 years? Over that time period, where the US dollar index is sitting right now, and this is as compared to other currencies, right? We're not talking about its value in terms of gold or in terms of barrels of oil, but in terms of how it rates against the euro or the yuan or the yen or whatever. It's about at the mid-range or slightly higher from the mid-range that it's been over the last 40 years, which is a way of saying it's pretty darn stable, and it's on the higher side of stable rather than the lower side. I know there's a lot of hate for the orange tariff bombing man in the White House, and I'm not going to stick up or defend him, but I'm going to point out that if you want to point to a weak dollar and high oil prices, then you should go back and look at the guy that was in the Oval Office, about 15 years ago or so, and you make that comparison. Listen, the U.S. economy is amazing right now. And that's especially considering all the geopolitical issues around the U.S. Again, I'm not going to argue the point, but look at the scoreboard. Look at what things are supposedly panic items that people are worried about. And yet, what about the safety trade? Look at gold. Gold in the last month is down almost 16%. It's down, I think, 22% from its high that it hit back in whenever that was, January or February. Likewise, silver is doing even worse. Silver is down a good 20% in the last month and down well over 40% from its high, about 6 or 7 weeks ago. So no, I'm not rushing to go out and buy silver or gold or oil or any of that. But if I was going to make some purchases, I'd be buying good quality things that are on sale. And again, these are things that I already own. But let me just throw out some names from the Mag7. And again, I'm not a Mag7 fanboy. But look at NVIDIA right now. You can talk about all the circular investing and how we're in an AI bubble. But the bottom line is no one can make chips like NVIDIA, and all the ancillary ecosystem and infrastructure around the AI trade, meaning, the need for electricity and electrification and power and the data center build out. Any companies involved in that supply chain, whether it be uranium miners or copper miners or the companies that make the components. Yeah, they're all down over the last month because of the war issues. But overall, the gains from those companies are significant. They continue to move up. These companies are very profitable. And I think the investment overall in electrification and automation and artificial intelligence is a generational trend. And the undisputed leaders of that are some of the people in the Mag7, right? The NVIDIAs, the Metas, the Microsofts. Oh, and let me step back here a second. I'm going to talk about a non-Mag7, non-technology stock that is almost identical in fundamentals to one of my favorite Mag7 stocks. And that's going to surprise you. So I'll get to that in a second. But let's focus on NVIDIA, Meta, Microsoft. Now, these companies are not going out of business anytime soon. Pull up a chart, look at how depressed their stock prices are right now, but then look at the bottom line. Each of these companies is expected to grow their earnings over the next 3 to 5 years at rates well into the double digits. I'm talking about 18% growth rates for Microsoft, 20% growth rates for Meta, 39% growth rates for NVIDIA, and these are growth rates per year, right? So even if they only grew at half those amounts, those are still substantial, above inflation, above GDP, and just above the general economy growth rates, even if they just grew at half of those numbers. So the growth is excellent. Let's look at the price. and I'm looking at forward price to earnings ratios, these guys are all below 20. You go back, I don't know, a couple years ago when everybody loved them, and I think they were all like in the upper 30s or 40 times. What I'm saying here is I think these are good quality companies that are being offered at a reasonable sale price. And furthermore, let's talk about their gross margins, right? These are companies that make money. So yes, they're spending a lot to build the infrastructure. But these, again, are very high profit margin companies. NVIDIA, gross margins over 55%. And those have come down significantly as their chips have been more commoditized. But they're still world-class, and they get paid a premium for it. And what's even more beautiful about companies like Meta and Microsoft is they're not really making physical products. They're in the digitized world. So it's much more profitable to move around electrons than it is to move around carbon. And likewise, their profits are higher. Microsoft, gross margins 68%. Meta, gross margins over 80%. So do they spend a lot? Yes. Can they afford it? Yes. Should you run out and buy them? No. I'm not telling you that. I don't know your particular situation. But these are amazing, global, powerhouse companies that are not going out of business anytime soon, and their price, not only nominally, but on an earnings-adjusted basis and a growth basis, is at extreme low levels. One final thing I'll finish up on. As you probably know, one of my favorite, or if not my favorite, Mag7 stock is Google. And let me share a stock with you that I don't talk about very often. In fact, rarely ever do I talk about it. I rarely own it, but it is an amazing stock. And right now, it is comparable in terms of fundamentals, and its overall characteristics are incredibly similar to Google. And that company is McDonald's. Go out and pull up a data sheet on McDonald's. It's trading at 21.5 times forward earnings, which is extremely high compared to what we just talked about with the Nvidias and Metas of the world, which are growing at a much faster rate, which again just shows you the insanity of the sell-off right now. But McDonald's, standing on its own, comparing its 21.5 or so price per earnings ratio, its 8% growth rate, and I think it has a 57% gross margin. Those numbers are almost identical to Google, except that Google is growing a pretty good clip better. I think Google's growing earnings at maybe 12 or 13%. But certainly McDonald's is no slouch, growing earnings at 8%. In any case, I thought that was interesting that two companies so different are actually being priced very competitively by the market, which again shows me that things are a lot more stable than what the media would have you believe. But hey, no surprise there. In any case, I'm marking myself safe from the global panic.